All right, so we will continue from where we left off. We are doing our equity option trading framework, conceptual framework. So this is all the knowledge that you're going to use when you do your option trading project. So we'll just recap quickly where we were before. We're still going through the where we finished the other day. We're still going through some of the basic elements. So we have gone through what the aspects that you have to specify in an option in order to completely specify the option that you're discussing. That's one. Then we went through what are the additional decision problems that arise in the case of trading options because of the peculiar characteristics of options. So you have to specify all this stuff. So you already know this, we've discussed it. And then some additional decision problems here, which you, after buying it, whether you exercise it early or not, or whether you should square your option position. As I said, normally you would square, even in the case of American options, American style options, you should, ideally you should say American style options, okay? Don't say American options, because in American options, people might understand, by American options, people might understand options trading in America. So in America, mostly these are your American style, but some of the index options are European style. So always say American style or European style or Bermudan style. Okay, so these are the, so some of the additional decision problems. Okay, and then we discussed that when you do market making in options, there are some additional decision problems which we are not going to discuss. But you should be aware that if somebody asks you when you did options, you have to specify. If someone asks you in an interview or somewhere else, when you join, when you sign up, or when you end, start your new job, when they ask you what did you study in options, when you studied decision problems, you studied it from the perspective of speculative, option traders, not from the point of view of market makers. Okay, so you did not study dynamic hedging by option market makers. So this, you have to be aware that there is something else which you did not study. All right. So we'll start here with option valuation models. So the brief introduction. This is a new material that we are studying for today. So, okay, now you already have some introduction to this because we have discussed the difference between price and value. So if you go back to your, if we go to the calc file here, I would like to open maybe an options file as well. My volatility. I would like to open a little option, some Microsoft options as well. Okay, let's leave that because there will be streaming ads on that web page. Okay, so where are we here? Yeah, so we were discussing price versus value. Now you're familiar with this discussion already because we have done this before. And let me put this here. Yeah, okay. So what we want to discuss here is this particular module on option pricing, option valuation models or pricing models. Now we have to bring back to the table the distinction between price and value. Okay. So what you have to learn here is, now in the industry, once again, this you have to put on, you have to be thinking at two levels. Okay. If we're thinking at two levels, let's not make this, let's make this so that it's the same thing. All right, okay. But we are discussing the difference between price and value, which you're already familiar with. That price is something which is objective, okay? That you look at something and you see the price. As you can see here, we have the US election coming up on Tuesday. The interesting stuff is happening. The S&P 500 has come down quite a bit. This is the SPY ETF. Okay, so this price that you see, this whatever the price is right now, okay, here you can read it off from here, whatever the price is here. This is the price. The price is objective, and therefore there is no dispute about what the price is especially in a market where the prices are transparent, like exchange traded markets. So you can see what the price is objective, okay? And value is always subjective. Fair value, there's one difference when we come at, when we talk about certain types of arbitrage-free valuation models. This is not subjective, but that's the rare exception. So we'll discuss that separately. But generally, value is subjective. So when you do all your, when you did all your forecast-based valuation analysis in your first year, which is your bond valuation. Okay, generally, if it's not a government bond, then there's some uncertainty about the cash flows. But more importantly, what you did in stock valuation, when you did your Gordon growth model and any other equity valuation, enterprise value equity valuation models where you're forecasting cash flows, these are all subjective because the cash flow forecasts are subjective. They are prone to error, and there's no guarantee that these things will turn out to be correct. Your project NPV, all of these are subjective. So this is a recap that we want to have: price versus value. Okay. So now what happens in industry, you have to think about at two levels. Okay. So when you go into industry, people will be referring to option pricing models. So when they talk about things like this, we go here. Okay, so they'll be looking at this, and they'll be saying that, oh, okay, you're looking at your option pricing model spreadsheet. But actually, what they mean is, this is an option valuation model. Okay, we're going to call it OVM. Okay, not OPM. Option valuation model rather than option pricing model. So the correct terminology would be a valuation model. Okay. Not the pricing model, because pricing, you don't need a pricing model for this, because the prices of options are what is happening here is, if we look at, let's open this one, maybe there are fewer ads on this website than the Yahoo Finance. Okay, now look at this. This is actually Oracle. We'll change, it doesn't matter. In this, for this discussion, we can just keep it as Oracle. So these are Oracle options on Oracle common stock. If you look at the, something's happened here. It's not loaded properly, actually. We need to see the full, let me just make this. Yeah, let's make it Microsoft, because when it loads, it should actually, okay, maybe I have my Zoom was too big. Yeah. Okay. So maybe we have a little bit here. Right. Now, can you see the stuff here? What we are trying to show you here is that now these are, when you put in Microsoft as the ticker, and this is what you're going to have to do. You're going to use this link, and you will just put in the ticker here, and it will change the price display. So what I mean by pricing model, why is this not a pricing model? This is not a pricing model because you don't need a model to figure out the price. Okay, the price is already, they're calling it option value here, but it's actually just this is actually just the price. Okay, you can see it's the same thing here in both these columns. Okay, so these guys have also made a mistake. They shouldn't call it the value, they should call it the price. Okay, so what I'm trying to say is that the price is something that is these prices that you see. This is the November 13th, okay, call, okay, which is $9.8 per share. The November 13th call, the strike price is 197.5, and the underlying price is 202. The underlying asset price is 202. The point I'm trying to say, the point I'm trying to convey by saying that this is actually, you don't need a pricing model, is because these prices that you see for call options on Microsoft at different strike prices and for different maturities. Here's a November 20 maturity expiration, and this is the November 13 expiration. These all these prices that you see, these prices are being determined by the interaction of buyers and sellers in the marketplace for these options. Okay, so you have a market for Microsoft 197.5 strike options expiring November 13th. And in this case, what you're in this market, what you're exchanging, one asset is the option contract, the call option contract, and the other asset is US dollars. And right now the price is $9.8 per share. Okay, so in this market there is buying and selling going on, and people are, through that interaction of buying and buyers and sellers, the price is being automatically determined. Okay, so if you look at any kind of price display where the price moves around, you can see that this is the that interaction is happening between buyers and sellers, and they're determining the price. So that's what I mean by this is an option. You don't need a model to determine the price. The price is being determined in any market by the interaction of buyers and sellers, which is what we call price discovery. If you remember, we learned a big term. That term is called price discovery. So there's price discovery happening in most liquid markets on a regular basis through the interaction of buyers and sellers. So the point I'm trying to emphasize here is that this kind of stuff is actually not a pricing model. It's actually a fair value model or a valuation model. And the reason I say that is because you don't need a model to price the option. The pricing of the option is being done in the market for that option through the interaction of buyers and sellers. Okay, so this is actually wrong terminology which industry uses, academia also uses, because they're not sufficiently careful about the distinction between price and value. All right, so you don't need a, but what will happen is that you have to think at two levels. When you go into the industry, people will use this terminology, this option pricing, OPM terminology, to refer to stuff like this. Okay, and you can have more sophisticated software. Even on the IBTWS, you can get option pricing software. So you can get a little application for option pricing. So there are many such applications, and all of these are going to be referred to as option pricing models. But actually what they are is option valuation models. Okay, and when we say valuation, always remember valuation is what is called, valuation is fair value. Okay, let me just write it here. I'll just pick it up from here. So you remember fair value is, and I'll explain to you why that is the case. Okay, valuation means, when we say valuation, we mean fair value. Okay, so this is what we mean. So it's a fair value model. So what I mean by this, when you're going to study models as well, what I mean by this, that this is a fair value model. I'll explain to you later. You'll understand it later as to why this is a fair value model. Generally, unless you're talking about this exception here for pure arbitrage, proper arbitrage-free valuation models, which we haven't come to yet, but there is an exception. So there is a category of fair value models which are objective, but generally fair value models are subjective. Most of the fair value models you're going to use in your life are subjective models, okay, including the option valuation model. Okay, so therefore these are all subjective models, and by subjective I mean that they are based on the subjective opinion of individuals. So different individuals may come out with different fair value estimates. All right, and we'll explain to you why that happens in the case of OVMs. But nevertheless, they are subjective. That's why the correct terminology would have been option valuation model or OVM. But that's not what people in the industry are going to say. They're going to say OPM. And you have to understand that, okay, that's the lingo for referring to stuff like this. But you should also understand, and for your own conceptual clarity, that this is actually should have been called OVM, where fair value model is the option valuation model, and this is actually a fair value model. All right. So this is the first thing you have to understand. So fair value means you have to understand that is subjective. All right. So I'll just give you a brief idea as to why that is subjective. One main reason why it's subjective is these are all the model inputs, okay, and this is the primary model output, and then there's a secondary model output which is derived from this primary model output. But these are all the model inputs, okay. So the main reason I'll tell you why it's subjective. The other inputs also are slightly, there is some dispute about that, but these are easy to figure out. What is not easy to figure out is this input. We'll explain in detail later on when we get into the understanding of I ball and H ball. But this input this ball input that goes into the OPM, okay, or OVM actually. This vol input, this is a subjective input, okay? This is an estimate, okay? So if I'm the option dealer and I am pricing, I am actually, again, in industry, people will say pricing model. And because I also come from industry, I've also got used to saying that. But actually, this is an evaluation model. So when I'm trying to figure out the fair value of this option, all right, with these kind of parameters, I will have to put in an input for this. And this input, okay, as you can see here, if you go back to your, the earlier part, where we have talked about the aspects of an option contract here. See, also required by option pricing, full, also required by option VM model, actually, OVM, to be supplied by the market maker. Okay, what are there? Volatility of the underlying asset. Okay, so this is not perfect English. I've not written the underlying asset, but let me just write it. Okay. This vol is supplied by the market maker, okay, the input, and it's the vol of the underlying asset. And what is this vol? This is what is expected over the life of the option. So there should be two more the's here, which I've not put in, okay? So what is expected over the life of the option, all right? So this is what we are entering in this particular field. The vol input is the vol that is expected over the life of the option. We'll come to understand later what this is, okay? So this is what we are entering here. Now, obviously, what is expected over the life of the option, we actually have no way of knowing that. So therefore, it is quite possible that different market makers for the same option, everything else is the same, but if you have two different market makers, they may come out with two different estimates for what is the vol expected over the life of the option. And that is what makes these models, and there's no way to tell whose estimate is correct. Just like when you go back to your old project-based analysis, okay, you do a project analysis. Now there's no way to tell. Different people come up with different fair values, okay, different NPVs for the same project. The basic facts are the same, but the cash flow estimates are different. So the NPV estimates for different students are all different. And there's no way to tell in advance, if you're dealing with a real life project, there's no way to tell whose estimates are correct, whose NPV is correct. That you'll only find out eventually in the future after several years have elapsed and what actually happens to the project. Then you'll find out whose NPV estimate was closest to the reality. So in advance, ex ante, there's no way to figure out. Okay, so it's exactly the same problem that you have, and that's why these are subjective fair value models, because the vol input, at this point you learn only this much, that the vol input is subjective, and different dealers will have different estimates for what the vol is expected over the life of the option. Okay, that's what makes this subjective. So this is basic. I mean, the first fundamental point you learn is that industry will refer to it as an option pricing model. Actually, it's an option valuation model. It's a fair value model. Whenever you think of valuation, generally it's a fair value model. And what fair value means is, in general, here the price is here, but I may have a different estimate of the fair value. I may have a different estimate. I might say, okay, the price is here around $330, but according to me, the fair value of this ETF is actually somewhere here, okay? So it's 280 based on my projections for the earnings of the component stocks in this ETF. So we have Shoya, you need to switch off your video. Okay, so I might say my estimate of the fair value is 280. So this is again based on my subjective projections for the earnings of the component stocks. All right. So this is what is meant by fair value. So where you come up with a estimate for what the asset is actually worth. Okay, what is the true worth of the asset as opposed to what is the price of the asset, which everyone can see. Uh, but you come up with something that differs usually from the price of the asset, and that refers to what you think is the true worth of that asset. Okay, somewhere here, or maybe somewhere much higher. All right. So that's basically what it is. Just to remind you about what fair value is. So these are actually OVM. Okay. Now, I've already talked to you about this. We have written it out here in the notes. Price discovery. Pricing, you don't need a model to price the option because pricing has been done by the option market. As you can see here, Microsoft options, prices are available. This is coming from the interaction of buyers and sellers. You don't need a model to get this done. Okay, so these are fair value models. So I've given you other fair value models. We discussed it several times. Gordon growth model, etc. Should be the value of the asset. Maybe we'll change the language a little bit. True worth, that's the idea. Okay. Forecast-based model, we have already discussed all this, are a species of fair value models. Okay. Now, inputs, outputs, discount rate. This is the Gordon growth model that we have discussed. Okay. So, I'll just give you a little bit about the common option pricing models, because this is one of the points that we discussed in our faculty meeting, that when people learn about options, what should they learn? So one of the things people said that they should actually know the names of some of the common option pricing models. So we'll give you the names. Now, the most common option pricing model is this one actually. It is loosely referred to as Black-Scholes, but actually it is let me put a clear difference. No, actually, there should be a comma.
Sir, it is a option value model or price model, sir?
This is the discussion that we had so far. In the industry, they will call these option pricing models. But I
Yes,
have this way because I want you to understand it at two levels. I want you to understand that option pricing, what industry refers to as option pricing models, actually
active valuation
called option OVMs.
Yes, sir.
Is this clear?
Yes, sir.
So that's what I mean. So the common names that you need to understand are these actually. Now it is normally referred to as the Black-Scholes model, but actually what we refer to as is Black-Scholes-Merton. Maybe we should put a. So these are the names of three people who are both of these actually have received the Nobel Prize. This guy died before that was before the Nobel Prize was given, but they have both received the Nobel Prize in economics. So this is the most commonly used option, the OVM for equity options, Black-Scholes-Merton. Then you have another very important model, which is the binomial model. All right, so these are normally used for equity options, but binomial can be used for others also. Some of the other famous option pricing models, which you can remember. So you will know that when people are referring to these terms, this is what they mean. So Garman-Kohlhagen for FX options. There is one for interest rate options. One is Black-Darman-Toy, and one is Holy interest rate option model. So these are some of the option OVMs. Okay. But mainly what you have to understand is that these are option pricing, what industry calls option pricing models, are actually option valuation models, right? This is a very brief introduction to option pricing and valuation models. Just wanted to get you into the discussion because we are already referring to these things, all right? So now you understand where the subjectivity comes from. It's because this input, the vol input, is a subjective estimate of what will happen in the future. Right. So this is basically all we have in this little sub-module. Now we'll go on to the moneyness of options. All right. So you'll see this. I think I've given you a hyperlink here from Options Education. You can look at this. It's a very good website. You can read material on this website. So, and I've also given you the link, I think, on the top of the notes. So what we are going to learn in this particular sub-module is what is called the moneyness of options. Maybe this is actually a term of art. So let me put a little inverted commas here. So we're going to learn three things. ITM stands for in the money. Okay. ATM stands for at the money. That is, I am standing at the bus stop. I am in the room. And out of the money. OTM stands for out of the money. Okay. Which is I have gone out of the room, out of the money. Okay. So this hyperlink is there. I mean, you see where this picture is taken from. I just wanted to put it in here so that we don't have to open any links as such. Okay, so this is basically what we mean. What we are learning here is that the value of value of any option has two components. Okay, so this important learning here in this particular module is key terms like this. First is the term called moneyness. Okay, this is important. You need to understand what is meant by moneyness. If you're talking about moneyness of options, what we are referring to is whether this option is in the money, at the money, or out of the money. That's what we mean. So obviously you have to understand these three terms as well. Okay, this is important learning. So this is how you should approach all of the material that I'm giving you. Okay, you cannot memorize anything. You have to have a list. That's why I said you should make your own notes, and you should have a list. And in this particular, when you're going through this particular module, you should understand what are the key concepts that we are learning in this module, in this sub module. And okay, so those will be moneyness, ITM, ATM, OTM. Okay, intrinsic value and time value. That's also important. Okay, so this is to be read. It's in the brackets. So intrinsic value, time value. This is how it's supposed to be read. Okay. So maybe I should just, to avoid any confusion, let me just put it here and take out the bracket. All right. So the other thing you have to learn is you have to understand what intrinsic value is and what time value is. All right. So now I hope everybody. So this is how you should approach all the material that you're learning in any of the three finance electives. There is always going to be certain, when you read the notes, you'll understand what are the key concepts. Okay, and I'm explaining it to you anyway in the class that watch out for this. This is what we are learning, and you should make sure that you have a list of those concepts, and then you go through that list as a checklist, and then you make sure, okay, I understand what moneyness is, I understand what intrinsic value is, and that's what is important. You can express it in your own language. You don't have to memorize the language, but it's important to understand conceptually what it is. All right. So, so the first principle we are learning is that the value of options. Okay. In this case, actually, we should talk about. This is not the right terminology actually. When you look at the price of an option, okay, the price of an option actually has, although we are using the word value in the, this is because this is all industry lingo, so I don't want to say intrinsic time, intrinsic price, or time price, etc. So they refer to it as intrinsic value and time value, but really what it is the price of the option. So you look at the option price, like here, you look at November 13th, 197.5 strike call on underlying asset, Microsoft. Okay. The price is 9.8. Okay. And then now we are going to say this 9.8 has two parts to it. What are the two parts? It has this 9.8 is here on the LHS. Okay. So let's say 9.8 as an example that we saw here. This is the it's the average price, average of the bid and ask is 9.8. What does this consist of? It consists of two parts. Whenever we see this, we can see that it consists of two parts, intrinsic value and time value. Now, what is this? IV and TV. Let's look at IV first. IV is basically, look at this, right? This is actually for, this is only for calls, okay? This is for calls and this is for puts. So maybe if we open the hyperlink, we'll see a fuller explanation here, okay? But I'll explain the concept. First, I'll write down the concept. So options premium, okay? This is a better way of putting it. Option price or premium, let me put this here. So the option premium is the price of the option. So you can easily remember this because when you buy your car insurance, now I don't know if I've mentioned this to you before, that insurance is essentially a type of option. Okay, the insurance company is selling you the option and you're the buyer of the option. So you buy fire insurance for your factory, or you buy car insurance for your car, or you buy medical insurance. These are all cases of options. Okay, these are all option products, so that's why what you pay is the premium. Okay, and it's the same consistent terminology when it comes to options on financial assets. So we say either the price of the option or the premium of the option premium. So what they've said here is, right? So this is, you'll see the better explanation over here. Okay, I just extracted this image. So a call is in the money, and this is actually, they have stepped away, they have gone ahead a few steps actually. Let's understand conceptually what IV is, okay? Let me explain this. I've not explained it here, okay. Okay, let me explain what IV is here. Conceptually, this is what you should understand. I hope everybody by now understands what is meant by exercising the option, okay? So a call option is an option to buy, a put option is an option to sell. So when you exercise the option, you basically exercise the right that exists in the, through your possession of the option contract. And so if you have a call option and you exercise it, then you buy the underlying asset. This is what, if you remember, Siddharth was referring to a couple of sessions earlier. One of the ways you can make money in an option is, with an option, is by exercising the option, buying or selling the underlying asset, and then immediately squaring your position in the underlying asset, market for the underlying asset. So you exercise it at the strike price. Okay, so for instance, if you buy this option, after you buy this option, okay, strike price is 197.5. Okay, so what does exercising the option mean? The question of exercise arises only when you buy the option. First, you have to buy the option, and only then can you exercise it. Okay. So after you exercise the option, when you exercise the option, what do? You go to the person who sold you the option, and you say, okay, I bought this call at 9.8. I paid $9.8 a share, and the strike price is 197.5. Now I want to exercise my option, so please sell me the shares of Microsoft. If it's one option contract, then it's 100 shares. Please sell me 100 shares of Microsoft at 197.5, because I bought a call option with a strike price of 197.5. That means I, as the holder of the option, I have the right to buy Microsoft stock at 197.5. You sold me that right. Okay, so now you better fulfill your promise, and I want to buy at 197.5. Okay, although the market price for option Microsoft is actually 202, right? So this guy has to fulfill his promise because it's a contract. He has to discharge his obligations under the contract. And so he sells it to you at 197.5. This is what is meant by exercising the option, all right? So you, in the case of a call option, you buy the underlying asset. And in the case of a put option, you would sell the underlying asset. So when you exercise your option, and then as what Siddharth was referring to, that one of the ways you can make money is you get to buy the option. We're not talking about commissions here or exercise costs and other stuff, but ignoring all that, you buy the option, okay, at 197. You buy the underlying asset at 197.5 by exercising your option, and you see that the market is trading at 202. So you immediately sell the 100 shares that you bought by exercising the option, and you make a profit of 202.47 minus 197.5 per share. All right. Now this is what is meant by exercising the option and then squaring your position in the market for the underlying asset. So you make money this way. So now the question is, when we are trying to understand what intrinsic value is, instead of remembering, if you go to the website here, they have not explained it well actually. I'll just put down the explanation. The way to understand intrinsic value is asking yourself this question. You have to ask yourself a question, which is, if I exercise this option right now and then immediately exercise the option, either buy or sell the underlying asset, depending on whether I'm holding a call or a put, and then immediately square my position in the underlying asset market, which means in the case of a call, I would have bought the underlying asset. So immediately square my position, which means I'll immediately sell off the underlying asset which I bought by exercising the call. In the case of a put, it's the reverse. So if I exercise my option and then square my position in the underlying asset market, what money do I make or lose? Okay, we can just say what money I make. So let's put it this way. Intrinsic value. Okay, let's put it this way. Let's learn the concept. Once you learn the concept, this formula they have given here, this is actually a formula kind of a rule they have given you, but you need to understand the concept, which is more important. Okay, so let's write it here. Intrinsic value. Okay. Say we have ignoring transaction costs. Transaction costs include brokerage, etc. Okay. Let's put it in practice. The option can be call or put. Let me make it much clearer so that you have the concept of exercising also once again here. When you exercise the option, what happens? By exercising the option and buying, selling the underlying asset. Okay, this is what happens when you exercise the option. In the case of a call, you buy the asset. In the case of a put, you sell the asset. Okay, and so we are recapping all our concepts at the strike price. Okay, and immediately squaring of the position let's make everything very clear so there's no confusion here. Underlying asset. By trading, we mean buy, sell. All right, so that's what we're talking about. So when you want to answer this question of what is the intrinsic value of this option, of any option, all right? So in this case, I see that the option, so what did we learn here? That the option premium or price determines, it consists of IV and TV. So what is IV? How should we understand IV? Well, IV is the profit, okay? Let me make this clear, not loss. Okay. Let's put this here. If the above process will lead to a loss, then we let's put it this way. Maybe we here at this point we don't have to put this. Okay, so I'm asking you to ask yourself this question: what profit can I make by exercising the option and buying and selling the underlying asset as the strike price, exercising the option there, call or put, and let me make it very clear. This is thereby, okay? Thereby, let's put this in the bracket so that you understand what is meant by exercising the option. It means to thereby buy or sell the underlying asset at the strike price. This thereby is meant to connect this part of the sentence to the exercise of the option. Okay, this is what is meant by exercising the option. And let me split it up maybe to understand it better. Two-step thinking, okay, and two, maybe we can put the and here. All right, so two things: exercising the option, okay, and immediately squaring off the position in the underlying asset. Okay, so if I do these two steps, okay, what profit can I make? What is the quantum of the profit that I can make by doing these two things? Exercising the option, which will lead to either buying or selling the underlying asset at the strike price. And then immediately, so when you buy or sell the underlying asset, you obviously end up with a position in the underlying asset. Okay, if you buy it, you have a long position. If you sell it, you have a short position from the exercise, from exercising the option. And then what is the second step you do? Immediately square off the position that you acquired in step one in the market, by trading in the market for the underlying asset. So if you want to quickly recap, what did we do here? We bought this, we paid $9.8 per share for a Microsoft call expiring 13th November with a strike price of 197.5. Okay. Then these are American style calls. We immediately exercise the option, call option. So we bought the underlying, by exercising, we bought the underlying shares at 197.5, one contract, option contract, so 100 shares. So we bought 100 shares at 197.5 by forcing the seller of the option to perform his discharge his obligations under the contract, option contract. And we bought 100 shares of Microsoft at a cost of 197.5. This is step one. Step two, immediately square off the position in the underlying asset. Then what we did, we saw the underlying asset mark is 202.47. So we immediately sold off 100 shares at 202.47. So what profit did I make? Selling at 202, buying at 197. Okay, so this minus this is, remember, profit calculation. Exit price minus entry price. This is my exit price. This is the first transaction, is a going long. Second transaction is squaring off the long. So exit price is here, entry price is here. What is the profit calculation? Exit price minus entry price. General formula, you can apply it in every situation. So exit minus entry, and position is a long position, so it will be with a plus sign. So 100 shares into position size into exit minus entry. We are not even showing the formula here, but you can understand what I mean. So position size is 100, exit price 202.47, entry price 197.5. So to do this minus this into 100 shares. That's your profit. Okay. So in this case, the intrinsic value of the option is, this is basically it. Okay. Intrinsic value is the quantum of the profit that can be made by following these two steps: exercise option and then square off the position that you acquire in step 1 in the market for the underlying asset. Okay. Now, if by doing this, you find that in this particular case, which we discussed, we are making a profit. So we can say that 9.8 is equal to, what is the profit we are making here? 47 and 198 is 4.47 and 4.97. Am I right? We can check it here. Okay, so we have 100 shares. We have exit price of 202.47. Am I right? Yeah. And entry price is 197.5. All right. So yeah, maybe it's a good thing to do it here. Okay. What is this? This is number of units. This is exit price. This is entry price. Okay. And then we'll have intrinsic value also. But let's say, so the PNL, okay, PNL is equal to number of units into exit price minus entry price. We have to what happened?
Sir, you have by mistake selected the A17 cell.
Okay, okay, good, good. Yeah. B. Good. So this is your PNL. Okay, now this is a positive PNL. Now this is the general formula. If your position was minus 200, this would be a negative. So it automatically, for the formula is a general formula. Okay, so in this case, we bought 100 shares. If you had sold 200, you would have put it with a minus sign. Okay, so this is your PNL. Now, this is your PNL. Now, what is the formula we have taught you here? That IV is the profit that you can make by following these two steps. Okay, and what does it say here? If the above process will lead to a loss, then we write IV as 0. We don't write, so for instance, if it was a put option, okay, and it was minus 100, you have a loss. In this case, we don't say that IV is minus 497. We say, actually, when we are discussing IV and this is actually when we are discussing IV and TV, we are discussing on a per share basis. Here I have made it 100 shares because one option contract is for 100 underlying shares. So that's a different matter, but you have to look at the actual price. Okay, so in this case, you will always put, for IV calculation, This is the P&L calculation, but IV calculation, you have to only put one contract. Okay, so put one contract, okay, which is, all right. Okay, so P&L per share, okay, P&L per unit. This is how you should write it. P&L per unit, okay. That is per option contract in this case. Per one option contract, what is this? P&L is 4.97. Now, what was I saying here? So in this case, we write the IV as this. So if, now let's look at IV, let's look at intrinsic value here, okay? So intrinsic value will be, let's put it here like this. Okay. So the intrinsic value will be this is basically this, okay? So if this turns out to be negative, then we write IV as 0, okay? In this case, intrinsic value is equal to 4.97, okay? So in this case, and what is the option price? Okay, the option price is, I'm not going to write the full intrinsic value, we'll just write it, or I'll put it as a very small font. So I can put in one more option price. All right. So option price is 9.8. Okay, as you can see here, the option we are studying 9.8. I hope this figure is visible to you. 9.8. We are now interested in the November 13th Microsoft call with a strike of 197.5. Okay, so in this particular case, the price that we see in the market, it's a mid price. In actual fact, when you are buying or selling, you'll have to sell at the bid price will be lower than 9.8. And if you're buying, you'll have to buy at the offer price, which will be higher, offer or ask price. That will be higher than 9.8. But let's assume here that we can trade at the mean. So you're buying it at 9.8. So the option price is 9.8. Okay. And so in this case, the intrinsic value is this. I need one more column somewhere. Okay, let's make this even smaller than this. Or let's just write it as IV. And we can make it bigger. All right. Let's write it as IV. And let's put it here. Make it easier. Let's put the option price here. Okay. So the option price is 9.8. The IV is, we'll put it here. In this case, we'll just put the IV equal to this, 4.97. Okay. Actually, we should write you'll understand the way to write it. If, I think we put this like this. If this, I hope I'm getting the syntax right. If this greater than 0, I think I'm making a syntax error actually here. Then I want, if this is greater than 0, then I want E17, else I want 0. That's basically it. Now I may have made a syntax error. Okay, let's make this negative. Let's make this, yeah, so it is correct. Okay, so you understand what I did. You understood what I did there. Okay, so this is how you write. And this, in fact, the way you write the formula straight away tells you what the concept of IV is once you know how this particular number came about. That this is the P&L, okay, from exercising the option and squaring off the underlying asset position. So if you write it this way, that if and remember, because of this, why am I writing this formula like this? Because of the last line and the other definition, the rest of the definition. What is the profit by doing step 1 and step 2? But if the above process leads to a loss, then we write the intrinsic value as 0. Okay. So that's why the formula for intrinsic value is if this thing, which is the P&L from following step 1 and step 2, if the P&L is greater than 0, then write the P&L for IV. Else, I want to write P&L for IV is the value of IV is here. The value of the P&L is here in E97 or E17, and if otherwise, you should write 0. Okay, so that's why IV is 0. I hope everybody has understood by now. Okay, and now we are going to break up the option price into the IV and the TV. Now, if you see here, I hope everybody is understood here. I'll just finish off the whole session and then the whole discussion, and then you can see. And the TV is very easy. TV is mechanical. Okay, so the main conceptual understanding here is the IV. All right. So TV, and this you can see, you can observe it in the market, option premium. You can observe it in the market, and TV is nothing but option premium is just rearranging the terms. Initially we said premium is equal to IV plus TV. So that means TV is equal to premium minus IV. That's all. That's what they're showing you. TV is equal to premium minus IV. Okay. So in our calculations, remember, we are ignoring the transaction costs and all that. Okay, but this is normally what we assume when we write the components. We will assume that there are no transaction costs. So if I want to write TV is going to be equal to today. Let's put today's date. We're doing it here. No? So today is 11/2. Good. Okay, so TV, now I need to write TV. I want to center all this stuff here. Maybe we should center this also, looks better. Yeah, okay. All right, so TV is going to be equal to, because IV is, option premium is IV plus TV, therefore TV is equal to option premium minus IV. 9.8 minus IV. Okay, so 4.83. Right, so this is how this comes around. The 9.8. So this is what we are learning here in this module, that we are learning the moneyness of options. So one of the important concepts in that is how the option premium can be split up into IV and TV. So the important concept here is IV, and I've given you the steps. If you follow these steps, you'll figure out what the IV is, or the profit is from following step 1, step 2. And if it's not a positive P&L, then we write the IV is equal to 0. Otherwise, we write the IV as whatever the profit is. Okay, and then TV is just equal to premium minus IV. All right, so you've learned this. So when you see one of the exercises you can do to understand this concept properly is whenever you see any option price, you can do an exercise for yourself. Okay, look at this option price, let's say 7.875. What is this option? This is the call option. What is the strike? 202.5. And what is the market option? It's 202.47. So it is almost equal to the market price. Okay, the strike price is almost equal to the market price. So in this case, if you exercise this call option, buy it at 202.5, then sell it at 202.47, it's actually a loss because your exit price is lower than the entry price for a long position. Okay, so you actually make a loss. So in this case, the IV is 0. So immediately you know that one of the things you can see immediately is that this 7.875 is completely this only consists of TV. This whole price, because here 7.875 is the option price here 7.875, the IV is 0, and the whole thing therefore consists of TV, right? So this is what so you can do this kind of exercise for yourself. And another thing I would say is that let's put in a little bit of a statement here, because in this case we are not discussing much, but we will just write that this part is written here, right? So we'll just write one more thing, which is that time value so the option premium is the market price of the option, okay? So mainly a function of, so what is the question is basically one of the questions that will arise in your mind is once you understand, once you look at this option, hey, you look at this option now, November 20th, Microsoft call at a strike of 202.5. This is actually going to lead to a loss if I exercise the option and sell it off in the market, because I buy at 202.5 and I sell at 202.47. So the IV in this case is 0 and the option premium is 7.875. So that means that if price consists of IV and TV, and IV in this case is 0 because the exercise leads to a loss, so we write it as 0, the IV. So in this case, I can see that the entire option premium consists of time value, 7.875 of time value. Now, the question is therefore that time value is mainly a function of, okay, two things: the volatility estimate implied by the option premium, okay, which is the market price of the option, okay, and expiry date, or we can call it tenor of the option. Okay, so I'm using the American spelling, the tenor of the option. Okay, and so these are the two factors, mainly the two factors. That's why again I've said mainly. There could be other small impact from the other inputs, but mainly time value is an impact, is mainly a function of higher time value and it will be not really that, but sorry. Higher vol estimate is going to lead to higher time value, and they should be longer tenor. Okay, let's just use the shorter, longer tenor. Now remember, tenor is not an estimate. Okay, tenor is not an estimate because tenor is something that you as the price taker have to specify to the dealer who is the price maker or the market maker. Tenor is not an estimate. You notice I've used different words here. Volatility is an estimate, okay? But tenor is not an estimate because we know precisely what we are looking for. 30 days to expiration or 90 days to expiration. So in this case, there is no uncertainty about this. Okay, there is uncertainty about whether on November 20th, the market price will be below 1202.5, below the strike or above the strike. There is uncertainty about that. But there's no uncertainty about this. Once you specify and buy a November 20th call option, there is no uncertainty about the tenor. That's why I don't write estimate of tenor. Tenor is very clear cut. It's known with certainty. So longer tenor means higher time value. And obviously you can flip it out that if it is lower vol estimate, then lower time value. Shorter tenor means lower time value. Okay. So essentially what we are saying is premium is equal to IV plus TV. Therefore, TV is equal to premium minus IV. Okay. And the other thing is in cases where IV is equal to 0 and premium is equal to TV totally, premium is completely equal to TV, like in this case. In this case, premium is completely equal to TV. Now the question that you might that might arise in your mind is, so what determines the TV? All right. So in general, what I will say is that TV is mainly a function of two things. One is the volatility estimate and the other is the tenor. Okay. So, and we'll explain a little bit more about the volatility estimate. And this is the tenor. These are the two things two factors which drive the price, which drive the TV, quantum of TV in an option. And what is the relationship? So what is your, if you look at your first derivative, okay, the higher the vol estimate, okay, the higher will be the time value, the longer the tenor, the higher will be the time value. Okay. And what is the vol estimate? So if you can see here, this is the vol estimate in an option. If you assume that the option market price is also using, the option market as it were, okay, through the interaction of buyers and sellers, but they're also using this kind of an option model. And if they're coming out with the option price of say 3.02, well, that means they must be using a vol estimate of 25. Because if they were using a vol estimate of, let's say, 45, then the price changes, 3.01, 3.02, price changes to 5.29. So again, you can look at this. If the actual option market price is 5.3, okay, then what you will say with these other parameters, because these are all known with certainty, because the user specifies them. So if you see that the market price for the option is actually 5.296 call option, then you can say that what do I mean by this statement? Vol estimate implied by the option premium. Okay, now the option premium is here. This is the option premium. If I see, now this is, remember, this is an OVM. This is not necessarily an option price. Like these are actual option prices. This is an OVM. This only tells me that according to this model, this particular OVM, if these are the inputs, this should be the output. This is what an OVM does. Okay. Same here when you're doing your, NPV, project NPV. You come up with an NPV figure. What does it mean? This is a fair value model. It means that if these cash flows are correct, if my cost of capital estimate is correct, then this should be the NPV. That's all it means. But of course, those two are big ifs. Okay, especially the first one, the cash flow estimates, they may not be correct. So that's what it means. So this is basically what this means. It's an OVM. If you see that, so first you look at your OVM, and the OVM says that these are the inputs, including most importantly the vol input. if these are the inputs, then this should be the fair value of the call option price according to this model. If I believe this model to be correct, this is a fair value model. If I believe it to be correct, then this should be the uh, option price. Okay, this is the fair value of the option. And if you happen to then look at the marketplace for options and you find that the actual market price of the option is equal to your fair value estimate. So the actual market price for the call option is 5.296. Then you can say that this is what you can say then, this statement. The volatility estimate implied by the option premium. You look at the option premium in the market, it's this. So then you can say that the vol estimate implied by the market price is 45. Because you can see from your OVM that, because these all are clear cut, okay, that with these inputs, if your vol estimate is 45, these are, remember, these are percentage, okay, these are per annum percentage figures, just like an interest rate kind of figure. But obviously vol is not an interest rate, but it is expressed in the same way. So you can say that the vol estimate implied by the market price is 45, because if these are all, these are the inputs, then this should be the output according to the OVM. So if we assume that the market price is following the same logic of the OVM, okay, the same logic as the OVM, then it will come out with this kind of a, if we're feeling the market is following, the market price is following the same logic, the manner in which the market price is arrived at is following the same logic that is there in the OVM, that is implied by the OVM, then we can say that if this is the market price, then the market must be estimating vol at 45%. That's basically what we mean, all right? So therefore, this is time value is a function of this vol estimate implied by the option premium, and it's a function of tenor. Okay, and you can test it out yourself. Let's look at it. Let's make this, and no, let's complete one more important learning here. Okay, the three terms: ITM, ATM, OTM. Very simple. Okay, uh, very simple formula. Okay, ATM, strike price is equal to current price of underlying. This is, I'm just giving you a call, okay? Example for call options. Okay. The main thing is that in the case of ATM, the strike price is equal to current price of underlying, okay? The in the money option essentially is, let's look at this way. Now let's define at the money and ATM and OTM differently, okay? ATM is, this is called as just an estimate, okay? This is an example. I'm going to first define it in general terms. I'll just write it here. ATM is strike price is equal to current price. These are general definitions in the sense that they apply to both calls and puts. ATM is equal to strike price is equal to, the strike price is equal to current price of underlying, okay? When we just say underlying means we are referring to the underlying asset, which in this case of Microsoft calls, Microsoft puts, Microsoft options is the common stock of Microsoft Corporation. That's the underlying asset, okay? So ATM is equal to this. What is OTM? OTM just means that IV equals 0. Very simple logic. Now you have already understood what IV is, okay? We can use the full term by just copying it. Can we save some space here? ATM is very easy to understand. At, which means strike, is equal to current price of underlying. OTM is implies intrinsic value is 0, and therefore ITM implies very simple logic. Okay, ATM, OTM, no, this is ITM. Right? ITM is in the money, OTM is out of the money. That you can see from the notes here. Okay, when you read this, you'll see this. They'll in the money, okay, out of the money, etc. They've explained these terms. Okay, you can read them here, but you can understand it here as well. So OTM is out of the money, ATM is at the money, and ITM is in the money. The logic for this: ATM strike price is equal to current price of underlying. These are general definitions, apply to both calls and puts. Okay, and so okay, ATM is this, OTM means just IV is equal to 0, and ITM means in the money means intrinsic value is greater than 0. OTM means intrinsic value is equal to 0. Okay, so this is basically, these are the concepts that you need to learn, the 3 concepts here. That, and we can write down here these full terms. Okay, ITM, OTM, ATM. I don't think they're written here anywhere. In the money you can understand is ATM. Okay, ITM, we can just explain it here in case it's not explained in the just for your reference, so that at the money these are not implied, these are in the money. Okay, so ITM means in the money, OTM means out of the money, ATM means at the money. These are very simple terms. We can put them in one line. Hopefully they all fit in one line. All right. Okay, so these are just our definitions. Okay, the full forms. But the more important concept is, so in this module, what you're learning is 3 things, very important things. Moneyness, we haven't covered that much ground, but make sure that you understand it very thoroughly. And once you understand it clearly, revise it once, and then you'll never have to study it again. It is completely embedded in your brain for life. Moneyness of options refers to whether it is ITM, ATM, or OTM. Full form of these I've given you. Okay. What is the important relation? Premium option price that you see in the market consists of IV and TV, and therefore TV is very mechanical. TV is price minus IV. So what is IV? IV is, go through this exercise. Okay, what do you make any profit by, or what is the P&L by following steps, 2 steps? Exercise the option, which means you end up with a position either long or short. If it's a call, you have a long position. If it's a put, you end up with a short position, which happens from the exercise of the option. And then step 2, immediately square off that position in the market for the underlying asset by doing the opposite transaction, obviously. Okay. If by doing step 1 and 2 you make a loss, then you write IV as 0. If you make a profit, then you write the profit as the IV. IV is equal to the profit. Okay. The intrinsic value is equal to the profit. So therefore your option premium, as you saw, is option premium 9.8 consists of, in the case of the Microsoft option here, 9.8, November 13th call, strike of 197.5, consists of IV of 497 and TV of 483. Okay, TV is mechanically defined, premium minus IV, but it's important to understand that TV is going to be driven by two important inputs, ball estimate and tenor. Higher the tenor, higher the TV. Higher the ball estimate, higher the option premium. Okay, higher the TV. Okay, TV component of the option premium. So these are the relationships that will exist. Okay, and so, and then you can actually see, now you can see here what this means. Okay, that here this is actually for, this is for calls. Okay, this is more mechanical actually. I don't want you to, you should just make sure, just read it later on. But first you understand the concepts in the way I have taught you in this module, because this is just mechanical. This is for calls. IV is equal to current stock price minus strike price. Okay. That's why you can see here, this is what they're saying, but this, what I have given you is a more general definition, that if IV is not positive, if the PNL is not positive from those steps, then you write IV as 0. And this is for puts, strike minus current stock price. But this is much more mechanical, okay? I would suggest don't worry about this so much. You understand the concepts that I've taught you here. This is more important. Moneyness of option refers to this. Premium consists of IV plus TV. What is IV? You figure out from here what is IV, okay? It can be 0 or non greater than 0. Then TV is equal to premium minus IV, and TV is affected by these two. And then what is the general definitions? ATM means strike equal to current price of underlying. OTM is means that intrinsic value is 0, and ITM means that intrinsic value is greater than 0. So if you look at some options here, we discussed two options. This option is in the money, because in this case intrinsic value is greater than 0. This option is in the money. We discussed two options. This option is in the money because it's the IV is greater than 0. Okay, so that's why it's in the money. IV is greater than 0. This option is actually, we discussed another option, this one, which is basically almost at the money, because if you round off the 202.47 underlying asset price, if you take it as 202.5, then the strike is equal to the underlying asset price. The strike price of the option is equal to underlying. So IV is equal to 0 in this case. Okay, so that's why this is at the money. Okay, at the money means strike is equal to, here also the IV is equal to 0. Okay, here out of the money also IV is equal to 0. Strike ATM also IV is equal to 0. Okay, so we should actually when ATM, okay, because in the case of ATM, so I should not write it just like this, because this is not then uniquely different from this, because in the case of ATM also IV is equal to 0. OTM generally means that when IV is equal to 0, even though option is not ATM, okay, that is, it's not at the money, but it still has 0 intrinsic value because of the way we have defined intrinsic value. Okay, so it is out of the money typically, and now you can see this as an example where in this case you'll see out of the money options, where essentially this is an example of an out of the money option. If you see 205, this is an example of an out of the money call. I'll just quickly wrap it up here itself. Strike price is 205, it's a call option, and the underlying price is 202.47. So this option, you will actually, if you exercise and follow those two steps, you will actually lose money. All right, so that's an example of an out of the money option. Okay, so that's what it is. So you can see in the case of a call, if the strike price is higher than the underlying asset price, that's an out of the money call, right? And this is an at the money call, and this is an in the money call. So you can revise it later once you're done. And how much time did I take? I took 2.5 minutes. Okay. All right, guys. So your class is dismissed now. Those who have questions can stay back, and the rest can go. The class is dismissed. Okay, so we will discuss Shaurya's administrative question regarding his login later on. But before that, does anybody have any technical questions or conceptuals? Mithali has raised her hand. Yes, Mithali?
Sir, I wanted to ask about my interactive broker login, because if it has iBot problem, then how will I able to trade it in it again?
Okay, 1 minute. So we'll come to that. That's an administrative question.
Okay.
Anybody else has a conceptual question, like relating to any of the concepts we discussed or other concepts? A technical question or a conceptual question? Then we will include that question in the video recording. Otherwise, we'll stop the video recording, and then we discuss these administrative questions like login problems and all that. Anybody conceptual question? Okay, so we'll stop it now here. We'll stop the recording, and then we will discuss